Your life insurance questions answered. Do life insurance policies expire? Can you lose a life insurance policy that you've paid on for years? The short answer is yes, you can. It depends on the type of life insurance policy that you own. You see, life insurance policies are commonly broken into two different and very distinct categories. On the one hand, we have permanent life insurance. Permanent life insurance doesn't really expire. It's intended to exist for your entire life, so long as you pay the premiums or you satisfy the conditions to reach paid-up status. On the other hand, we have temporary forms of insurance that are commonly referred to as term life insurance. Term life insurance policies do expire. They have a definite date at which you can no longer keep them, and this is absolutely an expiration date. So you could own this type of life insurance for a number of years, you could pay a lot of premiums, and it may go away before you end up dying. It is important to understand that if you do own term life insurance, that doesn't necessarily mean that you're in a bad place. Lots of people buy term life insurance for a number of different financial needs, largely ones that they believe are tied to temporary needs. This could be something like a mortgage on your home, having children and wanting to have life insurance until they reach adulthood, or having any other financial obligation that you believe will exist for a defined number of years and then it will go away. So what does the expiration of term life insurance look like? It actually comes in two sort of conditions. One is bona fide expiration, and the other one is not necessarily expiration, but for all intents and purposes, it's basically expiration for most people. Okay, let's start with the more common situation, which really isn't expiration. Most term life insurance policies that are purchased today are what we call guaranteed level term life insurance policies. What this means is they come with a guaranteed premium for a certain level of guaranteed death benefit that exists for a predetermined number of years. Most commonly, these policies come in guaranteed level term premium years of 10, 15, and 20 years, though you may find some going as far as 30, and for those of you who are younger, you might even find a policy that has a guaranteed level premium period up to age 65, however long that may be, which could be longer than 30 years. With these types of life insurance policies, the insured or policy owner has a premium that he or she knows for a predetermined number of years. Let's take 20-year term insurance as an example because it tends to be the most commonly form of term life insurance purchased today. So in our example, if we have a male age 35 looking to buy $1 million of term life insurance for 20-year guaranteed level premium, the premium on that policy will be set at issue and will stay the same for 20 years. This individual can pay that premium for 20 years, have $1 million of term life insurance in place, and know that during that 20-year period, his premium will never change. But at the end of 20 years, the premium will change. And by change, I mean it will go up. The reason that the premium goes up at this point is because the insured has reached the end of the guaranteed level premium period. And so the insurance company says, you can keep your coverage, but you're going to pay more for it because you're now much, much older and the risk of insuring you has certainly increased since the day you bought this policy. Under this situation, the insured or policy owner can certainly keep coverage so long as he's willing to pay the new and much higher premium that comes along with his $1 million of coverage. Very few people actually do this. What more commonly ends up happening is people go out and shop for new life insurance policies, new term life insurance policies at this time. And what they find is they can buy another policy, perhaps another 20-year level term policy at a premium that is much less expensive than the premium they would need to pay if they kept their current policy with a rising premium. But whether people choose to buy more life insurance or just cancel the policy that they have now, most people look at this as a sort of forced expiration date because in many circumstances, the new premium on one of these level term policies becomes exorbitantly high and oftentimes is cost prohibitive. Now, alternatively, if you own a permanent form of life insurance, these are commonly referred to as whole life or universal life insurance policies. These do not have expiration dates per se. So provided that you pay the premium that goes along with one of these policies, you can keep your coverage. The other thing that may happen is you could, with whole life insurance, satisfy the conditions to reach paid-up status. At this point, you don't have to pay any future premiums, and the policy will remain in force. This is a guaranteed feature of the contract, and it does not go away. However, some whole life insurance policies have a maturity date that falls before some people end up dying, which means the policy does expire. But there is a benefit that the policy owner gets during this time, or at this point. Maturity means that the cash value is going to equal at least the original death benefit. I say at least because some of these policies may earn dividends, and those dividends may increase the overall death benefit and cash value that is payable to the policy owner at maturity. Universal life insurance policies can also have a maturity date that works identically to the way I just outlined with whole life insurance. It's becoming far less common though, and policies issued in the last 10 to 15 years have maturity dates of age 120, so it's highly unlikely that many people will make it to the maturity date of their policy. This all being said, it's important to understand that you can lose a permanent form of life insurance, not necessarily because it expires, but because you fail to meet one of the obligations that you have as a policy holder. The most common circumstance where somebody does this is failure to pay the premium that is required of the policy contract. Now, you may be wondering, how does somebody fail to pay a premium on a permanent form of life insurance when theoretically they've been paying a premium all along? But there are many times people use the non-guaranteed features of these life insurance policies to cover premiums that they otherwise would have to pay. This might look like, for example, using the dividends on a whole life policy to pay the premium instead of writing a check to the insurance company to pay the premium yourself. There are some times when people do this and the premium payable on their whole life policy goes down over time, and unknowingly the dividend falls to a level where it no longer covers the premium. The policyholder receives a premium due notice, they ignore it because they assume that their policy is fine and it's being paid for with its dividends, and then the premium never gets paid. Another situation that does exist on occasion with permanent forms of life insurance has to do with universal life insurance and the inadequacy of premiums that get paid over a long period of time. Because universal life insurance doesn't have a set premium that the policyholder is necessarily obligated to pay, there is a situation where some people paid a lot less than they should have, and this resulted in policies that needed substantially larger premiums later in life that the policyholder couldn't afford. And in these situations, people lose their coverage. It's not because the policy expired, but it's because they were unable to afford the premiums that became a necessity from years of underpayment. So, to recap, term policies absolutely expire. This date could be long before someone ends up passing away. Permanent life insurance policies are not designed to expire, but that doesn't mean you're necessarily in the clear. You should keep an eye on your policy and make sure that the premiums that you're paying are adequate. Or if you're using some non-guaranteed feature to cover those premiums, that is adequate, not only now, but well into the future, to ensure that you don't later on have to start paying premiums or have to pay premiums that you may not be able to afford. Thanks for watching, everybody.